They're out of cash. I'm your host, Steve Metre, and thanks for joining me today. In our lead story, it's a major warning from Target as the U.S. economy is in danger, and the U.S. is not the only one. As you're about to see, we have some new evidence that shows the world's second largest economy is also in danger. Now let's head over to NBC, where we picked today's story up with a headline: is Target lowering prices on 5,000 frequently bought items? But it's the reason why. Is Target said Monday it will lower prices on approximately 5,000 items to stay competitive amid signs consumers are experiencing price fatigue. And this is something we were told wasn't going to happen because average hourly earnings continues to rise and outpace inflation. But there's a serious underlying issue here. Is what we're seeing is demand from the economy is getting weaker because total compensation, what people are earning every day, is not keeping up with inflation. They're seeing higher bills from their credit cards, from their insurance companies, from energy prices. Everything is starting to impact the U.S. economy in a major way, and now Target is faced with doing something we were told was not going to happen, and that's cutting prices to compete with the likes of Walmart. As the company said in a statement, the price cuts are concentrated on grocery staples like milk, meat, bread, fruit, and vegetables, as well as paper towels and diapers, with many cuts affecting company-owned Good and Gather and Everspring brands. So this isn't just a move to get people in on the discretionary side. Just like we heard from Walmart, what we're finding out is American consumers cannot keep pace with inflation. They're cutting their discretionary spending, and now we're starting to see an all-out price war between Walmart and Target and other retailers as they compete to get people in the door in hopes that they spend money on anything else. And this is exactly what you see right before a recession happens, right before you see consumer prices fall, because it's all about demand, and right now demand is plummeting. And we know consumers are feeling pressure to make the most of their budget, and Target's here to help them save more. And this from the Executive Vice President and Chief Food Essentials and Beauty Officer. Our teams work hard to deliver great value every day, and these new lower prices across thousands of items will add up to additional big savings for the millions of consumers that shop at Target each week for their everyday needs. And as the annual rate of inflation remains stuck above 3% and the Fed's key interest rate remains unchanged, many consumers are now starting to pull back on spending and becoming more selective about what they purchase. And I'm wondering, is that happening to you? Are you seeing that in your household budget where you're forced to spend less? And are you going to look to companies like Target who are cutting their prices to do that? Where are you shopping? What are you doing? I'd love to know. Make a comment below, because here's what we're seeing. This is all about people's paychecks, and they're getting smaller. If we look at total compensation in red, this is average hourly earnings of production and non-supervisory employees multiplied by the average weekly hours they're working. That on a year-over-year rate change against the consumer price index shown in blue. And what we've seen is the consumer price index slowed a little bit last month, but notice the trend here. We're continuing to see a slowdown in total compensation, again at a time where we saw energy prices jump, where we're seeing auto insurance rates and homeowner insurance rates go higher. Consumers now tapped out, running out of money in a big way. But there's another reason why we continue to see this in the survey data, not just at the factory level, but we're also seeing it in the services sector. There's a big move and a lot of comments by employers saying, well, we're cutting hours. And sure enough, this is the underlying issue. We'll get, of course, more data on this early next month from the, of course, official non-farm payroll report. But what we're seeing is periods where you see average weekly hours decline. What it leads to and is ahead of declines in inflation. You can see that in the blue line each and every time. And now we're seeing, of course, average weekly hours plateau here and more likely coming down as demand goes away, and employers have to say, we just don't need people here as much. But if there's one headline that changes everything, if you've ever seen a headline like this that said, wheat gains as dry weather in Russia exacerbates crop concerns, in which, man, I wish I knew how to trade that. Well, look at this. We showed our subscribers back here when to trade wheat. And look at this, it's taken off. And I'm going to show you the closing price as of Friday. Look at where it's rallying today if you would have just signed up for our reports. And again, we give you 30-day free trial. This is our CTA reports. You want to beat the machines. You know, you hear people go to Vegas, they want to beat the slots. Well, we show you how to beat the machines at the market. We show you when they're offsides in deep short positions and price is rallying against them. You can jump on our CTA report. Maybe you like to trade the technicals. That's our momentum time pro report. But look at these returns back from mid-March, and all you had to do is sign up for the 30-day free trial. Links in the description below. And then the next time you see a headline, you're going to be the one celebrating when you look at your brokerage account as consumers continue to be even more discriminating whether every dollar they spend as they face elevated prices, their day-to-day spending. Again, we look back to McDonald's and look at Target's biggest competitor, Walmart. They recently signaled even higher income consumers were turning toward their offerings as wallets are still stretched. And so we're going to see now retailers compete for consumers by doing one thing that the Fed says would not happen, and that's lowering prices. This is going to bring inflation down in a big way. And there's some other things we look at the economy as we turn back to Tesla, what we talked about this weekend. As chaos reigns inside Tesla as workers await next slew of job cuts. And you want to give people a reason to spend less? Well, when they start to see that their co-workers are losing their jobs, and you know the company's going to lay off more people. You've heard the bosses talk about more layoffs coming. There's no warning. And what happens? Then you see this. It's difficult to imagine the feeling of walking on eggshells every day at work, uncertain whether or not you'll be able to pay your bills or feed your family. It would be a relief to know that they can breathe and focus on their work without the gray cloud of uncertainty looming over. Is that happening at your work? Are you afraid of getting your hours cut or losing your job? How are you experiencing that? Please, if you give us some feedback in the comments. If we even look to new people entering the workforce, we see pandemic-era college kids face job market that doesn't want them. And what that means, of course, for parents, this is not good news. They're hoping to see their children graduate from college and get a job. Now it's looking like they'll be coming home. And U.S. employers are hiring at the slowest pace in nearly a decade, excluding a brief dip during the early pandemic. This, according to the Bureau of Labor Statistics. Fewer workers are leaving their positions, well, for good reason. They don't want to. They're afraid of this economy after layoffs at companies such as Google, Microsoft, Morgan Stanley, and Citigroup. And confidence among entry-level workers is the lowest in Glassdoor data going back to 2016. And this is going to change spending patterns as well as parents start to realize that maybe my kids are coming home. This is going to stretch their budget and cause them to look to reduce their spending in other ways. And how about the Fed? Well, even Fed Chair Powell had this to say, that he urged law grads, of course we know that have no job potential here in this economy, to think beyond yourselves because, well, they're going to have to do some thinking when they find out that the labor market isn't working in their favor. This is dangerous. He says each of you has the capability to achieve success in any field. Now, as long as, of course, the Fed keeps interest rates high and the economy tight, you choose. As it's important, you also consider how to give back and use your gifts to make a difference. He says you need to think beyond yourselves. Well, how can you give back, Fed Chair Powell? If you don't have a job, well, of course, we turn more to the Fed. We see Barr saying policymakers should hold rates steady as he cannot see what's going on in the labor market as you see this further evidence. He says recent jobs data supports the possibility that we have continued employment growth while the disinflation process is continuing. So we're seeing disinflation at Walmart, Target going at it, McDonald's cutting prices as well, and they just don't understand how close we are to an all-out recession with the unemployment rate still below 4%. Given the resilience there, I think we have some space here to maintain our focus on inflation. What's going to happen is inflation is going to fall out of the floor very, very quickly, and the Fed is going to be late to respond. But as I mentioned, the U.S. isn't the only economy facing issues. Let's turn to China, who's got a major problem as capital outflow surges to the highest since 2016 in April. And this is really important to understand because if money was flowing out of China to other parts of the world, it was actually doing something, creating economic prosperity, then what would eventually happen is that money would flow back overseas into China and things would start to work themselves out. The problem is it's creating bubbles in a big way. An investor's favorite foreign exchange assets under the capital account in April, a sign they're more optimistic over securities that are not denominated in the yuan, and well, good reason. We're facing a lose-lose situation in China here, as the current account was also not supportive of the yuan, as it showed the net purchases of foreign currencies, which is a rare occurrence as China has long enjoyed a surplus from its exports. Service deficit linked with outbound travel also picked up. It's not only as people want their money out, they want to get out too, and you can't blame them. The currency's crumbling, the economy's crumbling there, and again, the PBOC, the powers that be, face a lose-lose situation, as the collapse in China's foreign direct investment inflows may be more of a reflection of comparably higher interest rates in the U.S. than of foreign firms losing interest in China. And this is exactly what I said would happen. As long as the Fed keeps rates well higher than other central banks, money's going to flow into the U.S. But what it needs to do is flow into the U.S. economy, but it's not. It's flowing into assets, creating bubbles, and eventually those bubbles are going to burst, as we've noted throughout history. They say non-resident firms, including Chinese firms within Hong Kong offices, may have moved their cash offshore to benefit from higher yields. Well, you can't blame them, because look at what the PBOC is doing here. You want to talk about failed policy, because the lose-lose situation here is money is leaving the country. And when that happens, the yuan's going to go down in value, which suggests, of course, what the market is telling them, you need to raise rates. They're telling PBOC, time to get rates up to be competitive with the Fed. The problem is they can't. As Chinese banks keep lending rate unchanged after PBOC gets all on hold, as China's economic recovery has been driven by strength in the industrial sector, but domestic demand has remained stubbornly weak. And that's a real key point here, because what the economy is saying is that rates are too high. So on one hand, you have the economy saying, look, we need lower rates to spur demand. On the other side, it says, look, this economy, the currency is going down, and you need to raise rates to keep money in. So you see they cannot win no matter what they do. As, of course, credit posted a shock shrinkage in April for the first time ever, an alarming sign of battered corporate and household sentiment. And we know that when credit starts to get into a contraction mode, well, it does not spell good things for a debt-based economy. Remember, commercial banks create money when they lend, destroy money when that loan is paid back. It's only the interest that stays in the system. In fact, we can look here at the U.S. data. This is the latest commercial industrial lending data, which is posted weekly, shown on a year-over-year rate change in red against the federal funds rate in blue. And what you tend to note here is decelerations or contractions in commercial industrial lending usually lead with a decline in interest rates, because what the economy is telling everyone and telling the Federal Reserves and the other central bankers around the world is rates are too high. There's a supply and demand mismatch. You've raised, of course, the bar for interest rates, and the market says we do not demand loans at that level. This is a dangerous game. China is going to lose in a big way, and you can see this even turns over to Japan as short when wagers linger due to gap between U.S.-Japanese rate paths. And again, this is all about central bankers thinking they know best when they don't. And here you can see the bearish yen bets curtailed after suspected Japanese intervention, but the market here remains very, very short. Big possible return on the yen at some point when, of course, we see the dollar start to weaken, but that will happen when the Fed starts to cut or the market starts to price in. And what we're seeing from Target, Walmart, McDonald's is U.S. consumers indeed. They're out of cash. They're in a dangerous situation. Number one country, U.S., looking to head lower. China may beat us to the punch. This is a dangerous game all these central bankers are playing, and the problem is it's going to affect everybody all around the world. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.